Uber and Disney just reported their quarterly earnings. We're going to get into it. Let's see what they did in the quarter. Let's see what the stock is reacting, and we'll put a price on one of these to see what we can pay for it. So the first one we're going to look at is Uber. So as you can see, Uber right now is down about 1%. And let's pull up the earnings report. This is always what I find interesting. Okay, now it's back to even. So Uber announces second quarter results for 2025. Now, I briefed this real quick. I just wanted to look for positives and negatives. What was positive? What was negative? I didn't find a lot of negatives. And you see the stock is flat. So trips and gross bookings grew. These are highlights. Grew over 18%. Income from operations of 1.5 billion. Adjusted EBITDA of 2.1 billion, up 35% year over year. Operating cash flow 2.6 billion. Free cash flow 2.5 billion. New $20 billion repurchase authorization. I don't know if that's good or bad. We'll have to make that determination as we start going through the numbers, but it seems like that's a highlight for them, and they're pretty excited about that. So that's what we're going to be paying attention to today with Uber, and let's continue on. So I want to get down to some more of those highlights. You could see we talked about the trips growing. We talked about the gross bookings growing. The income from operations grew 82% year over year. And then when we come down to these numbers and we're just comparing the changes, again, trips 18, revenue grew 18%, free cash flow grew 44%. Now, when you get down to breaking down more of the deliveries, Uber Eats, right? 20% increase. Mobility, I'm assuming this is what their rides are. 16%. So I'm not, the only negative I'm seeing here is freight. I have no idea what freight is. Is there such thing as Uber freight? I truly don't know. But man, there's not a lot in here that is bad from a financials perspective. There's not a lot in here from Uber's perspective that is negative. Now, I want to go back to stock price. Look, this is why I always say, be very careful trading earnings. Earnings are a total crapshoot. You could have the greatest things in the world, and you don't have the best results when it comes to the earnings reaction. Now, I'm not seeing anything in here for forward guidance. That could be something that they spoke about on their. Okay. Here we go. For the quarter going forward, gross bookings of. See, this is what I don't get. 48.25 billion and 49.75 billion, representing growth of 17% to 21% year over year. Positive. Our outlook assumes neutral. Okay, as a reminder, adjusted EBITDA, which is another. So typically what you'll see, if you see a flat to negative reaction, like we basically have still, is you'll see a fantastic quarter, like you just saw from Uber, and then forward-looking guidance will be a little bit lighter. And analysts won't like that. People won't like that in the stock market, et cetera. But that's not what we're seeing here with Uber. So why don't we go through and just take a brief look at Uber? So the community, 67.74% out of 31 people have this rated as a buy. We have about 20% as a strong buy. So people are liking Uber. Let's see. Profit margin is, they're profitable. Finally, see, if you look at the 5-year profit margin, it's basically nothing. But now they are finally profitable. So that's a great thing. The 5-year PE, I can't focus on that. The 12-month PE is 15. That's fine. Gross profit margin, I expected a little bit higher with it being really a software company. I mean, they don't have a lot of overhead. It's the drivers taking on their own overhead. Let's see what they're doing with the share repurchase stuff. Sure, there was a lot of dilution. Yeah, if you go back to 2016, they had about 1.5 billion shares outstanding. Now they have about 2.1 billion shares outstanding. They are going to start buying back shares. That is good, I guess, if you want to look at it from, it's a growth company. I don't know. I don't know if it's the best use of capital, but that's what they're doing. That's what everybody seems to be doing these days. And the 8 pillars are just not pretty, but it kind of is what it is. If you look at the PE, yeah, it's hard to put a PE on something like this. ROIC, it's going to get better, I have to say. They're going to be buying back shares. That's going to get a little bit better. Their free cash flow is outstanding from what we've seen quarter to quarter. So why don't we see what analysts have to say here? They see us going huge growth from $2.81 to $6.52 by the end of 2028. From a revenue perspective, we're doing 51.5 billion at the end of this year, going to 82.27 billion in 2029. That's significant growth. That is, I mean, who's Uber's competition? It's Lyft and maybe Waymo, maybe, but man, why don't we put a number on this thing? I don't think this is why this is difficult, because we don't have a lot of good history to base this off of. That's why investing can be difficult. It's hard because you're putting assumptions on something that you don't have a lot of history to base it off of. So if we look at revenue growth, why don't we go and put in here why don't we do 8, 12, and 16% revenue growth? 16 could be very high, but I do think 12 is probably that sweet spot number. So I'm going to go low, error low at 8. I'm going to error high. I'm going to go to 16. We'll just see how it goes. Profit margin, let's say 24, 27, and 30. Let's say they continue increasing that profit margin. For free cash flow, I'm going to put in the same numbers because they should be equal over a 10-year period. I mean, that's enough time for them to become a mature company, have some great balance going forward. 21, 24, 18, 21, 24. They absolutely should get a premium. I'm going to put in a 10% return. I'm not going to have any margin of safety for this one. Let's see what we have here. There's a lot of green, right? There's a lot of green out there. This is why it's rated as a buy in our community. Even if I put in a margin of safety, let's do 13%, 15%, and 17%. Let's see. Even with that, we still have green. This is why people in the community are paying attention to Uber. Hey, bud. Nice and easy. Teddy loves Uber. I even have a 13, 15, and 17% desired annual return. This is including any dividends that they pay in the future. But look at these numbers on the bottom. I mean, if my high numbers hit, you have basically a 29% return. Fantastic. So that's Uber. Let's go to Disney. Disney recorded their third quarter fiscal 2025 revenue increased 2%. Income before taxes increased 4%. Operating income increased 8%. Let's see what the stock price is doing with all of these increases. Oh, you're basically flat. You're basically flat right here. Let's continue on. Direct to consumer, interesting. Almost taking the Nike approach, increased 6%. Let's see. Disney Plus, 183 million, an increase of 2.6 million versus the second quarter of 2025. 128 million Disney Plus subscribers. Oh, this is Disney. I'm sorry. 183 million Disney Plus and Hulu subscribers. 128 million only Disney Plus subscribers. Still an increase of 1.8 million versus the previous quarter. Content sales, licensing, and others declined 275 million. Okay. Sports increased 235 million with an income of $1 billion. Let's see here. Year-over-year increases reflect the impact of a $314 million loss in Star India. I know they're trying to launch in India. Domestic ESPN operating income declined 7% versus the previous quarter. That this is something that is continuously happening with Disney, this ESPN section. So that's kind of unique. Looking forward to the final quarter of their year. Disney Plus and Hulu subscriptions an increase of more than 10 million. So they're expecting more increases there. They're expecting modest increases, which I assume flat over here. Earnings per share, $5.85. Let's see. They are expecting the sports segment to growth for the entire year. So that's interesting. Disney Cruises. I'm surprised. So I did search this before I started. I just wanted to search profit margin. They didn't mention anything about their profit margin. Now they could have very easily mentioned this on their quarterly call. I didn't listen to the call, nor am I going to listen to the call. But if you're listening to the call, I would pay attention and see, did they mention something about margins? Because if you've watched the channel for any length of time, Paul owns Disney. He has a thesis that their margins are going to increase. So if we come over here, we can see that their 5-year profit margin is 3%. They were always sitting somewhere in the 9 to 11% range. Now they're back to 9.5%. That's his thesis on this, is that they're going to get their margins to what they were pre-COVID. COVID just completely destroyed them. If you look at our community holdings, 71.5% of people say that this is a hold, 14% strong buy, 14% strong sell. There's only 7 people voting though. So let's see what we have here. Plenty of cash flow to pay out this $1.37 billion dividend. Let's see what else we have. Okay, there's not a lot. This is the big thing, is this profit margin. I think that's still, I think Paul is correct in saying that's the big driver of this. Nothing stellar here, but remember, this is coming out of COVID. If you look at COVID, look what happened here. You were doing 55 billion, 59 billion, 69 billion, 55 billion, 67 billion, then you continued your climb. So you had a little lull in here. I mean, remember, they shut down their cruise ships, they shut down their parks, and when they opened their parks back up, actually in China, they were shut down for a long time. But when they opened their parks back up, it was not the same. They were letting in less people, et cetera. So I think that their timing of Disney Plus was actually pretty solid, that it did help them immensely, just because it was able to kind of compensate for the lost parks and lost cruises. Okay, looking at the future, analyst expectations. $5.85 going to $6.73. Nothing spectacular. Revenue, 96 billion to 106 billion. Again, nothing spectacular, but it's Disney. I don't know how. You don't necessarily need 15% growth every year to do something miraculous. So let's go here with let's do 2.5, 4.5, and 6.5 revenue growth and profit margin. So I'm gonna do this. I'm gonna go 5, saying that they're not gonna get back to what they were. I'm gonna go 7, they're almost there, and 9 to what they were. Okay, that's kind of how I'm gonna balance that one out. I'm gonna put the same things here. They should get back to equaling each other out. Now, I'm gonna give them a premium. I'm gonna go 20, 21, and 24. 20, 21, 24. No, I don't want to do that. I want to go 20, 23, and 26. And I'm going to go 20, 23, and 26. And I'm going to do 10% return here, okay? I'm going to put a margin of safety in a second. Let's just look. Okay, there's your numbers. You have 42 on the low, 124 on the high, 75 in the middle. Now, if I put a margin of safety in here, I'm going to do 12, 15, and 18%. That's probably too high. Let's do 12, 14, and 16%. Let's see what that does. Okay, 36 on the low, 37 on the low, 80 on the high. I mean, you're getting close. I'd probably put this on my watch list around $100 and see what happens from there. But this was Disney. This was Uber. They reported. There's a lot of good things in both companies. So if you like videos like these, subscribe to the channel and check us out next time. Have a great night. Bye-bye.